Hi and welcome to this eMentor 5-minute tips video on how to choose a lender and product. So this is just a quick introduction to some things that you should consider when you're choosing lenders, when you're presenting lenders to clients, and also when you're choosing products too. So it's not just about the rate, it's about the lender, it's about the product, it's about all of the other features associated as well. So the first section here is lender and product features. So the kind of key features here: fixed versus variable. So make sure you know the kind of key differences, pros and cons in regards to fixed and variable. What is the market? What are the market projections over the coming years? Have a strategy for your client depending on their needs and their preferences. Present the information to them, and then you can recommend in regards to the best options here. Flexibility. So do they plan on moving? Do they foresee needing additional funds for renovations or anything like that as well? That can also be linked into features. So let's say clients will want access to funds, but in a couple of years, a secured line of credit may be helpful for them. If they may be moving, you want to make sure the mortgage may be portable, or they have a variable rate where the penalty is less to pay out the mortgage as well. Do they like flexibility? Are they expecting any significant changes in their lifestyles as well? Are prepayment privileges important? Some lenders have 10%, some lenders have 20%. These can vary. So there's other amounts of prepayment privileges as well. But if that's important to the client, let's say they're expecting a lump sum inheritance, for example, and they want to pay down the mortgage, then make sure you're doing this future planning and kind of your product and your lender has and the mortgage that you put your clients in has all of these features as well. And then next is know your rate category. So know if your mortgage is insured, insurable, or uninsurable. So as a quick summary, insured is less than 20% down payment where the client's paying an insurance premium. So often this is the lowest rate category that the client will be able to secure because they're paying that insurance premium. It's lower risk, and lenders have a lower rate category for this as well. Insurable, the summary way of thinking of insurable is it's $1 million or less, generally, unless it's a new build, and the client does have 20% or more, but it would fit into that insured category. So let's say they have 20% down payment, but the value is under $1 million. Amortization is up to 25 years as well. So with the insurable rates, these insured and insurable, the monoline lenders tend to be most competitive in these, and uninsurable, the banks tend to be the most competitive. So insurable, the best rates that are sometimes in line with the insured rates are if it's 65% loan to value or less. And then uninsurable, so if a client wants cash flow, maybe they want to amortize over 30 years, which means the rate would be higher than insurable rates potentially, or insured rates. However, they're able to spread those payments over longer and have that kind of cash flow benefit. Also, if the purchase price is higher, for example, as well, so if the value is a lot higher. There's different reasons files become insurable if they're doing a full refinance, for example. So I hope that makes sense in regards to insured, insurable, and uninsurable. And then the next one is lender exceptions and lender ratios, so qualifying. So qualifying is a really key one, especially if you're tight up to the ratios. So there's instances where a client will qualify with one lender, but they wouldn't qualify with another lender. So this is really where you can show your value as a mortgage broker. So know what lenders may grant ratio exceptions. So for example, banks are more likely to grant exceptions for TDS above 44, for example. Know what ratios they allow, what types of exceptions they allow. Know about their programs as well, so things like total net worth programs, business for self programs. Know what lenders are more flexible, what their underwriting criteria and things like that is, so you have the best chance of approval in the time that you need to get that approval as well. And then it's lender quality, so speed, how quickly can you hear back? If you have a tight subject removal, you need a quick lender. Underwriting, how streamlined is their underwriting? What paperwork do they require? If these burdens are too high on the clients, then they'll have a really bad experience and you'll get this unhappy face over here. And then finally, service. During the term, what's their service levels? And what will they be? What will the client experience be with that lender as well? And then finally, any other factors. So other factors include things like hidden fees, if there's restricted mortgages, for restrictions here, any perks, or are there any cashback. Make sure you're factoring these in when you're doing those side-by-side comparisons, pros and cons for different lenders as well, and just make sure you're aware of your competitors, potential downsides too, so any kind of restrictive clauses or any cashback clawbacks or anything like that as well. So that's a bit about how to choose lender and product, and you'll notice we don't talk about rate here because these are all the other factors that alongside rates you'll be comparing, so you can show that value in the big picture to your clients as well.